4.6 Self-employment taxes explained. Unlike the traditional W-2 employment model, where a company automatically withholds taxes from every paycheck, the burden of tax compliance rests entirely on your shoulders as a freelancer. This means you are responsible for calculating and remitting both state and federal income taxes, as well as the often overlooked self-employment tax, Social Security, and Medicare. However, if you remain a simple sole proprietor, you are likely overpaying. By strategically structuring your business, typically through an S-Corp election, you can lawfully minimize your exposure to self-employment taxes. Here is how that transition works and why it is the single most effective move for protecting your bottom line and decreasing the amount of taxes you pay, including self-employment tax lawfully. Understanding self-employment tax. Self-employment tax, also known as the SE tax, is a 15.3% tax that funds Social Security and Medicare. For traditional employees, this cost is split with an employer. But as a freelancer, consultant, or coach, you are both the boss and the worker, making you responsible for the full amount. Who pays it? You are generally required to pay SE tax if your net earnings from self-employment are $400 or more in a year. This includes sole proprietors, independent contractors, freelancers, coders, programmers, personal and business coaches, consultants, influencers, content creators, and the like. Single-member LLCs, disregarded entity. How to lawfully minimize self-employment tax. The most effective legal strategy to reduce this burden is when an LLC transitions from one owner to two or more. The primary change is the shift from being a disregarded entity to being treated as a partnership by the IRS. While both are pass-through structures, the administrative complexity and the way you report income change significantly. Number 1. The filing shift, Schedule C versus Form 1065. Single-member LLC, default. The IRS disregards the entity for tax purposes. You do not file a separate business tax return. Instead, you report all income and expenses directly on Schedule C of your personal Form 1040. Multi-member LLC. The IRS treats the business as a partnership. The business must file its own informational return, Form 1065U. S. Return of partnership income. The LLC itself still pays no federal income tax, but it must report the total pie of profits and losses to the IRS. Number 2. K-1 distributions, creating the slices. In a single-member LLC, distributions are not taxable events because you are already taxed on 100% of the profit regardless of whether you move it to your personal account. In a multi-member LLC, the process is more formal. Schedule K-1, the LLC issues a Schedule K, one statement of distributions of income, to each LLC member. This document tells the IRS exactly what slice of the profit or loss belongs to each partner based on their ownership percentage, or as defined in the operating agreement. Taxed on allocation, not cash. You are taxed on your share of the profit reported on your K-1, even if the business didn't actually distribute that cash to your bank account. Consider a multi-member, two or more people LLC structured as a partnership for federal tax purposes. If the entity generates $100,000 in gross revenue and incurs $40,000 in deductible business expenses, it leaves a net profit of $60,000 to be allocated to the partners. Under a 50-50 ownership split, each member is issued a Schedule K-1 for $30,000. The critical advantage here is how that income is classified. Because these are partnership distributions rather than W-2 wages or a formal salary, they are often treated as passive or investment-style movements of equity. In this specific structure, the $30,000 is taxed at your standard individual income tax rate. If your effective tax rate at that bracket results in a $1,500 liability, that is your total federal obligation without the additional 15.3% sting of self-employment tax. The process concludes with the LLC filing IRS Form 1065, which serves as an informational return. It transparently reports the $100,000 gross income, the $40,000 in itemized deductions, and the two $30,000 K-1 allocations. The business entity zeroes out, and the tax responsibility is successfully passed through to the individual members. Expenses look like this: accounting fees and expenses, advertising expenses, auto-related expenses, dues and fees, entertainment, meals, etc. Various fees, insurance fees, internet fees, and expenses. Inventory, merchandise, materials, legal fees, licenses, office expenses, office supplies, postage, stamps, shipping. Rent 50%, unless it's a rented office suite, then you get 100% write-off. Repairs that are business related, research done on behalf of the business, selling expenses, training and education expenses, travel expenses, utilities, etc. Let's say you totaled all those expenses up, and they came to an even $40,000 in total for your LLC business expenses. Then, you'd have two K-1 forms issued to both members, each in the amount of $30,000 to each member, totaling $60,000. You can see how the business zeroes out at the end of the year and owes no federal income tax for the business, and the individuals just have to account for $30,000 on their personal tax forms, along with any other personal income they might have received outside of the LLC. For maximum flexibility, each partner can establish their own independent LLC, which then serves as a member within a joint venture or partnership. By structuring ownership at a 99% and 1% split, both individuals retain primary control over their respective entities while legally qualifying for multi-member LLC status. This architecture ensures that both partners receive a Schedule K-1, unlocking the specific tax benefits associated with partnership distributions. However, choosing a partner for this structure requires extreme vetting. You are granting someone a front row seat to your personal and professional financial health. Select a partner who offers long-term stability, such as a spouse, a trusted family member, or a lifelong business associate, and avoid temporary relationships that lack a 5-year commitment horizon, such as a boyfriend, girlfriend, etc. Once your structure is set, the next step is to transition from thinking to acting by consulting a qualified CPA or tax strategist. Don't just settle for a generic preparer. Ask your network for referrals to a professional who specializes in entity structuring and K-1 distributions to ensure your foundation is built for long-term wealth preservation.